Hi, everyone. We're back. Hey, I just watched my last lecture. Oh my God, it's so boring. I don't know. If you guys are making through this, I'm impressed. I can't think of anything worse than taking accounting online. Anyway, let's see. We're going to take up where we left off. We're in chapter 9, 9.2. We are learning about sales and cash receipts. I am on page 307 in the book, if you care to try to follow along in the book. I did check your quiz scores, and things are looking pretty good for a lot of you. Some of you I'm a little worried about, but I was happy to see that a lot of the quizzes were good. Okay, I got to move me up here. So now what we're going to do is it's kind of like a little bit of a review. So they're giving you, which is good because this is very good for you that are going to be taking the final. So basically, it is giving you like a bunch of statements that you're going to enter into the journal. And, ultimately you would post them to the ledger. So you did that. That's what we did in section 9.1 is you learned how to post information to the ledger. So now you are getting multiple entries. And so what their goal is for this chapter is to try to teach you how to use a subsidiary ledger, which is very good. And it's very practical and it's not very hard. So anyway, these are a bunch of transactions that happened in Hal's, sorry, Arts Wholesale Clothing Company. I'm not going to go over each one. Okay, so basically they give you an outline of an invoice. So an invoice is like a bill. And so the invoice is coming from Arts Wholesale Clothing Company. They're selling to an independent, shop that sells men's clothing. And we have the items here. And if you've ever worked in any type of maybe retail establishment where people are buying things on accounts payable, then that is what this is. That's what an invoice is it's a bill. So basically, you have the terms of the account, you have what they bought, you have the company that bought it, and you have an invoice number. Okay, that's just point of information. Okay, so it says here that on April 3rd, you sold merchandise to Hal's Clothing for $800, terms 2/10 and 30. So what accounts are going to be affected? Just kind of like it's a little bit of a review. We just did that. So the first thing we're going to record is accounts receivable for us. Hal's owes us money, and then that's going to be recorded into sales. Okay, and then we have to go back to our inventory and adjust for the cost of goods sold and our merchandise inventory, which is decreasing. Cost of goods sold is acts like a money coming in. So that is, well, kind of acts like an expense. But remember, you need that in order to calculate your net profit. Okay, so we have kind of a little bit of review there. Okay, so now they're going to teach you about accounts receivable subsidiary ledger. So it's a special ledger. It's just for accounts receivable. And so basically what it does is it allows you to see each customer that owes you money. So that's why it's called a subsidiary accounts receivable. So it's a subset of the big accounts receivable account, which is very important. Remember, second only to cash is accounts receivable. So all your customers' businesses are going to be arranged in alphabetical order, tiny little point, of course, in accounting that we keep track of. And it can be organized in any manner, and it is basically, how you keep track of who owes you money. And it is posted to the general ledger and recorded in the subsidiary ledger. You'll see how that works. So here you have your general ledger, and these would be all your accounts from your chart of accounts. So you have a whole bunch of accounts, and you have the main accounts receivable. And we've already dealt with accounts receivable. That's money owed to you, and that is called the controlling account. And then everybody who owes you money, so each person that has an account with you, Roe, Mel's, Hal's, and Bevan's, that is your subsidiary accounts receivable. So all of these people have a balance they owe you. We sum all that up, and that's the amount that actually goes in accounts receivable. Easy concept. Okay, so the general ledger account, which is accounts receivable, that's called the controlling account. and it summarizes or controls all the subsidiary ledger, and total of the individual accounts will equal the accounts receivable controlling account ending balance. Okay, so here you have a nice big journal page before you are posting to your ledger. You have basically all of your transactions that happened during the month of April, how appropriate, and then you would post these to the ledger. Okay, and then these are simplified ledgers. Remember, going back to the T account. So here's your subsidiary ledger. You have that Bevins Company, Howes, Mel's, and Rowe Company. Those are all your individual accounts. And then you have your regular accounts that are what we've been studying mostly, which is accounts receivable. You have your merchandise inventory, which acts like an asset account, 100 account. You have your sales revenue. You have your two contra revenue accounts, which is sales returns and allowances and sales discounts, merchandise that's returned, and a discount that you give in the format of the terms of on your invoice for people to pay soon. And then your cost of goods sold, which acts like an expense. I don't think I said that in the last slide, but it is, in this case, it's a 500 account. Okay, so if you were to post to the ledger from the journal, you would basically go to the accounts that it says, and it's a kind of a nifty little thing. I don't know whether, I don't even think you do it when you do your homework. I don't remember ever seeing, you don't ever get to make this cute little check here. So when you do the accounts receivable, you're going to put $800 as a debit in accounts receivable. See it right here. April 3rd, General Journal, page 2 right there, and it's $800. And then you're also going to put it like 2 times. So you're going to put it in the individual customer who bought that clothing from you and owes you money. Okay, so then the others would be posted to the general ledger, just like you can see here. So your inventory is going to be credited, your sales is credited, and your cost of goods sold. Actually, I think that's a mistake. I think your cost of goods sold should be a debit. That's a typo. Okay, so then if you did all the transactions that were found in this journal here, then your T accounts would look like this. And so basically we go back to the old T accounts. You don't have to do the complicated modern T accounts. We're just doing the old T accounts. And then you would sum those up and you can get a balance in your accounts receivable. And that, of course, would go on your balance sheet, which I'm sure you all remember. So each one of these would also have a balance. So example here, something that happened. It looks like on April 6th, Bevins bought $600 worth of merchandise on account. So they owe you money, subsidiary accounts receivable. And then it looks like they returned some merchandise on April 12th. And so when you return the merchandise, that would be sales returns and allowances, and that would be a credit. So that would decrease your accounts receivable. And it would also go against your sales account, but it doesn't do that until it goes on to your, that would be your net income statement, 400 account. Okay, so you see it's on the debit side and all these are on the credit, so it would lower the balance in your sales account. Okay, so each one of these are posted to the ledger and they're all posted to the accounts receivable also. Okay, it's like you're entering it 2 times. Okay, so they're just giving you a term, and the term is a credit memorandum. So a credit memorandum is basically when a person has that sales returns and allowances, they get a credit memorandum because it is going to credit their accounts receivable. It credits your accounts receivable, so they don't owe you any money anymore. So this is a credit memorandum. So basically they're bringing an item back to you, and so they would owe you a little bit less money. Okay, so the same thing happens here. If you have to do sales returns and allowances, remember the little check just means that you put the entry into the subsidiary ledger. So this guy brought back a $600 whatever suit or some kind of clothing that they bought, And so that's a contra revenue account, so that's why it's a debit. And it is going to be entered in the sales returns and allowances account 412. And then your accounts receivable is going to be credited. That's why it's called a credit memorandum, because now Bevins owes you $600 less than they did originally. So if you remember this entry right here, we're wondering where that $600 was. That's the credit memorandum right there. Okay, moving on. Okay, so this one is a little bit of a review. It's not very hard. Sometimes people don't buy on account. They don't have an account receivable. They pay cash. And that is very simple. And we already know how to deal with that. So we've been dealing with it all semester. So let's take a look. So if people just pay cash, then we journalize and post them just like we have all semester long. It's not anything more complicated than that. It's pretty simple. So here's a bunch of transaction that happens. Just remember, sometimes there's cash sales. So these are just transactions that I'm pretty sure that you can enter them, and you're going to practice it in your homework. It's a bunch of transactions. So right here, for example, you are getting paid for what Hal's owed you. And when you gave them that invoice, you gave them a 2% discount if they paid within 10 days. So here they are paying you back. So originally they owed you $800. And instead of paying you $800, they only pay you $784 and they take the discount. You have to keep track of the discount. The reason why I keep track of the sales discount is because it lowers your sales. And that also in turn lowers your profit, but you got your money sooner. So that's the little price you pay. So basically what is happening here is they're paying off their accounts receivable. So the sales discount is the 2%. They took off the 800 and we have to keep that in a separate account. Okay, and then accounts receivable, if he pays it, that accounts receivable now has a zero balance. Sales discount has $16 and our cash account is debited for $16. Okay, so more business transactions. Got to watch my time here. Here's all the T accounts and they're all affected and they're all balanced here. So what happens in a business, oftentimes once a week, you sit down and you look at what's called your receivables, because those are people who owe you money. So that's, I guess, one of the least fun jobs of a person who's working in accounting is sometimes you have to be the bill collector and you have to look at Mel's department store and notice that they owe you $1,600. So you might make a phone call and tell Mel's, you know, you owe us a lot, $1,600. You can make a payment on that. Whatever. But that is why we have that subsidiary ledger, so we can see who our good customers are and so we can keep an eye out on people that owe us money. Okay, so when we do the schedule of accounts receivable, I only have 2 more minutes. You are going to always remember that your main account receivable is the controlling account. Okay, and when you enter it in the journal, you put the little check because you entered it in accounts receivable and you also entered it into the specific account. So this right here is the summary of the companies that owe you money. So that is what a schedule of accounts receivable is. As we go to all these, do our balances, and you can see that Bevins doesn't owe you anything between the merchandise they returned and paid their bill. Then they don't owe you anything. Same with Hal's, but Mel's owes you $1,600 and Roe owes you $500. So you have $2,100 in your accounts receivable. Sure enough, if we go to our ledger and balance it, it's a $2,100 balance. So the schedule of accounts receivable is something your boss would ask you for. Who owes us money? I want to see who owes us money. And maybe you're short that month and you need those people to pay so you can make payroll. So that is what a schedule of accounts receivable is. We're running out of time here. Oh, thank goodness. I think we're all done. So basically what we went over this last part, we did not go over sales tax payable too much. I will give you some homework on that this time around. I think I don't really have time to go over individual things. I'm down to 30 seconds. So we're going to call it good. Take it easy and check your homework. You should have a homework assignment coming up. Okay, talk to you later. Bye.